Hello and welcome to Livewire's Buy, Hold, Sell. I'm Selby, and 2022 has started off with a bang, but not in the way investors would have hoped. As many of you would know, the S&P ASX 200 has slipped around 7% year to date, and with inflation abound and interest rates likely on the rise, we thought we'd invite two Aussie investing pros on the show to see how they are positioning their portfolios over the year ahead. Today, we're joined by Simon Conn from IML and Bruce Williams from Elston. Let's talk about COVID-19. It's the reason that we're filming from home today, or for Simon in the office, but it also provided investors with plenty of opportunities to exploit mispriced sectors and stocks. Are those kinds of rotation opportunities available to investors in 2022, or are we more likely to see volatility and weakness from the ASX this year? Bruce, I might start on you.
Sure, Ali. I think we definitely will. We've got a lot of COVID-induced factors yet to play out. So if you think about fiscal and monetary stimulus, if you think about consumer spending habits, if you think about the way we work, all these things as COVID rolls through, we've got to unwind. And I think it will probably lead to a pretty volatile period and changing expectations for not only companies, but what we pay for them as well.
Over to you, Simon. Are there any rotation opportunities that are alive and well in 2022, or are you expecting volatility like Bruce?
Yes, I think, Ali, we're going to see quite a bit of volatility this year. I think January is a bit of a precursor to what we shall see through the year. I mean, the most dominant factor on the share market has been the ultra low interest rates that's been forced on the world by the US Federal Reserve and been copied by many other banks around the world. And as that ultra low interest rate environment unwinds, and I think clearly the Feds in the US has signalled that, saying that inflation is not transitory. We'll see bond rates move up as they did quite strongly in January, and that will lead to a big revaluation adjustment, particularly in those stocks that are high-ish growth, and a lot of investors have bid to valuations that just don't make sense for us.
Staying with you, Simon, I'd love to know, are you holding more or less cash than this time last year?
So our cash levels are about the same as this time last year, Ali, with a couple of percent in cash, but we do have quite a lot of stocks under takeover. So we've got about between 7 and 9% of the fund subject to takeover. So companies like AusNet, API, Cenex Energies, and Z Energy, which will turn into cash over the next 6 to 8 weeks. That gives us about quite a lot of firepower then to reinvest into those stocks that we think still represent good value. And I can talk about those a bit later.
Same question to you, Bruce. Do you have more or less cash in your portfolio than this time last year?
We have more, Ali. We recently got taken out of Sydney airports and we're yet to redeploy. And because of the environment we're in, the volatility, the unknown earnings season that we're going into, we thought we'd take the opportunity during that period to redeploy. We've got quite a few companies that we do like, that we are just waiting for the opportunity to purchase.
Bruce, staying with you, is there a sector that you're avoiding or rotating out of in 2022?
Yeah, Ali, if I was to choose one, it would be consumer discretionary, particularly retail. They've had a period of unbelievable demand because we'd had no other choice. We couldn't go out to dinner, we couldn't go on holidays, we couldn't do all those sorts of things that we used to. And in our view, it meant these companies are actually over-earning. As that rolls off, we think that consumers will spend more money on services as opposed to goods. And it's really difficult to work out what underlying demand will be going forward. You could potentially see that they've had earnings or they've had sales pulled forward into that COVID period.
What would make you re-enter the consumer discretionary sector or the retailers?
I think once we've got a feel for what normal sales look like and the growth rate of those sales, and for us it always just comes down to whether the valuation stacks up and we've got a margin for safety built in there.
Over to you, Simon. Is there a sector that you're avoiding in 2022?
Yeah, Ali, like Bruce was saying, we've been very cautious on the consumer discretionary sector and the discretionary, especially retail sector in particular. It was a perfect storm for them over the last 18 months with consumers locked at home, no overseas travel, and the JobKeeper stimulus providing effective wage increase for some people, particularly omni-channel pure online players, which we've been very cautious of. And those stocks, despite the pullback, we think they still are pretty full. So we're pretty cautious on the specialty retail sector. Margins look a bit inflated again, and the valuations don't reflect, I think, more normal underlying operating conditions for a lot of the companies in that sector.
What would have to happen for you to start buying up retailers again?
Look, I think it comes down to a stock-by-stock basis, Ali. So, there are stocks such as Best and Lest and Myer in the discretionary sector where the valuations look very cheap. And both stocks have been impacted by the shutdowns and lockdowns of those having to have stores closed. And their margins haven't been artificially inflated by what's happened. So, we think both those businesses on P's are less than 11 and 6 times in Myers' case, with good online opportunities. And we think the omni-channel way is a much better way to play, the growing trend to online. The pure online players for us are, pretty low margin businesses, really having to pay a lot of their margin away to Google to drive volume to their websites. So that's a sector we're very cautious on.
Staying with you, Simon, looking at your portfolio, which sectors are you overweight right now?
Yeah, 2 sectors, Ali, that we like are the consumer staples sector and the communications and telcos sector. Both have got fairly resilient demand. They're able to have some pricing power, and particularly the telcos are not subject to big cost of goods sold increases. And stocks in that sector look attractively priced for our money.
What would have to happen for you to take money out of those sectors, though?
Ali, look, it's a stock-by-stock situation. So if the valuations were extreme, obviously we would move out of those sectors. But at the moment, we're finding good value in the consumer staples and media sector and telco sectors in particular. Is
there a consumer staples and a telco communications player that you think is a winner in 2022?
Yeah, we particularly like Bega in the consumer staples sector. We really like the Lion Nathan Dairy acquisition. That's been something that's really enhanced the transition that business is making to a more branded consumer staples business. That generates a much higher margin, really, drives the business away from the more commodity-based routes. Business is trading, about 19 times and an EBITDA multiple of 8 times, which is a discount to international peers. Obviously, it's been impacted by COVID in the last 6 months, but as those imposts unwind, the business has some pricing power, and we think it's really well placed going forward. In the telco sector, we really like TPG. It's the number 3 player. It's a fully integrated telecommunications business that has been impacted by COVID with a lack of roaming, as people haven't been travelling and overseas arrivals haven't been coming to the country. But the merger between Vodafone and TPG really brings together and creates a real third force in the telecommunications market. So there's cost out opportunities. There's the fixed wireless opportunity, which we think can grow their earnings going forward. It's trading on about 13 times cash adjusted EPS, pays a good dividend, really good management team, and a business that just looks very, very cheap and underowned for us. And then one other thing we really like about it is the opportunity to crystallise the asset base they have. Telstra have just sold their towers business for 28 times EBITDA. TPG trades at 8 times, and they have a similar, asset base which they could then, sell a stake in to crystallise some value and pay down debt and accelerate the increase in dividends.
Okay, over to you, Bruce. Which 2 sectors are you overweight in 2022 and why?
At the moment, Ali, we're certainly overweight energy. We think with energy transition dominating the headlines, there's been a real focus on the reduction in long-term demand for your traditional energy companies. But we think a more immediate issue for them is a lack of supply. Going back sort of 3 or 4 years, we had very low prices that led to a real underinvestment in terms of capex and sometimes opex as well. So basically, there is a supply shortfall given the energy needs of the country, and we think they will be sensible going forward in terms of how they spend their money. We think they'll run them very lean. The commodity price that drives them is very good, so excellent cash generation, and we think on undemanding multiples, it's a really good spot to be at the moment. They also provide traditionally a bit of an inflation hedge, which we don't mind also.
Is there a second sector that you're overweight in your portfolio at the moment?
Yeah, Ali, we're not overweight at the moment, but certainly it is something we're focused very heavily on, and that's healthcare. Over the last couple of years, it really hasn't been the place to be from a price perspective. They haven't really changed over that period, whether it be COVID impacts, whether it be their defensive nature, or whether it be maybe a reasonably high multiple that they've since grown into. But certainly we think as COVID rolls off, a lot of them have been impacted through the deferral of elective surgeries. Hospitals been put over to deal with COVID, so very inefficient operations. We think, and also Australia has some very good healthcare companies to choose from. So that's an area we're really focused on at the moment.
What would make you take money off the table in those energy and healthcare sectors?
I think it's the same that make me put the money in the first place. It for us it comes down to a reasonable rate of return given the style of the company that it's in, and that we're getting rewarded for taking on the risk.
Are there two stocks within those two sectors that you're really liking at the moment that you think can outperform in 2022?
Yeah, from an energy perspective, we very much like Santos. It's got a lot of opportunities in front of it. They've been very disciplined and organised with how they go about it. They are reasonably low risk opportunities. So obviously the underlying price for oil and gas is very supportive of them. Lots of free cash generation. They're also looking at post their merger with Orsearch. They're looking at getting rid of non-core operations and also farming down some assets. So the balance sheet's really strong as well. So we think it's a great place to be at the moment. In terms of healthcare, we do like, and I'll have to put a caveat on this, we do like Ramsay. We think it's going to have a poor half year coming up. Obviously with elective surgery deferrals, I think they're just reinstating them in New South Wales this week. We think that really does knock them around, but going forward, all these deferrals, that requirement isn't gone. All it does is firm up your future demand. So we think they'll operate at very high utilisation rates going forward. We also think waiting lists, particularly in the public system, and this is not just domestically, this is overseas as well. We think the waiting list is a real political problem. So they'll start pushing public patients through private hospitals. They do have growth options as well, whether it be through procurement or brownfields development. So given its growth opportunity over the longer term, we do think the valuation at the moment stacks up quite nicely.
Well, that's all we have time for today. We hope you enjoyed that episode of Buy, Hold, Sell. I'd love to know what stocks you're backing for the year ahead. Let us know in the comments section below. And if you haven't already subscribed to our YouTube channel, we're adding new content every week.